Hello everyone. In this video, let's see about what is repo rate and reverse repo rate. Repo rate is nothing but an interest rate. Like how we take loans from the bank also take loans from the Reserve Bank of India when they are in shortage of funds. And the interest rates for those loans taken by the bank from the Reserve Bank of India is called repo rate. So now we understood the repo rate. So let's see about the reverse repo rate, which is nothing but an opposite of repo rate. So reverse repo rate is sometimes the Reserve Bank of India take loans from the small banks, and the interest rate for the loans taken by the Reserve Bank of India from the small banks is called reverse repo rate. So now we understood the repo rate and reverse repo rate. Let's see why it is so much important to know about the repo rate and reverse repo rate. Because by controlling the repo rate and reverse repo rate, we can actually control the economy of the country, economy of India. So the repo rate and reverse repo rate will be increased or decreased based on the economic condition of the country, economic condition of India. Let's take the economic condition is in recession, the economy is in recession, which means the circulation of money in the economy is very less, is decreased, which means people don't have much money in their hands, so they are not spending much. In order to boost the economy, what Reserve Bank of India will do, they will reduce the interest rates, which means if they are reducing the interest rates for the loans taken by the bank, then bank will also reduce the interest rates for the loans taken by the people. So now what happens, people can take loans at lower interest rates, which means it will attract the people, companies and financial institutions to take more loans, because the loans are now available at low interest rates. So they can take loans and they can invest in somewhere like shares, golds, assets, and people can spend more to buy whatever they want. So by reducing the repo rate, RBI is trying to increase the circulation of money in the economy, by which it can boost the economy. Let's take another example. Suppose the inflation of the country is very high, which means the prices of all the products in the country is high. So what happens when the prices of the products are high, then it will reduce the value of currency of that country, which means rupee will lose its value. In order to protect the currency, what RBI will do, the Reserve Bank of India will increase the repo rate, they will increase the interest rates, which means they are increasing the interest rates of the loans taken by the bank. So banks will also increase the interest rates for the loans that are taken by the people. So people and companies and other financial institutions don't show interest in taking loans from banks, because now if they take loans, they have to pay much interest rates. So they don't show interest to take loans from the bank. So by increasing the repo rate, RBI is actually reducing the circulation of money in the economy, so that people and other institutions, companies don't have money, so they will reduce the investment, they will reduce buying products, so that the inflation will be controlled. So now let's see about how the reverse repo rate, changing the reverse repo rate can impact the economy. It is actually much similar to the repo rate. When RBI increases the reverse repo rate, we have seen the reverse repo rate is nothing but the loans taken by the Reserve Bank of India from the small banks. So when the RBI increases the reverse repo rates, then what happens? Small banks will show more interest to give loan to the RBI. In return, they can get high interest rates from the Reserve Bank of India, which means RBI is taking the lump amount of cash from the banks. As a result, it is reducing the cashes in the small banks. So banks will not, or they will reduce giving loans to the common people or companies or financial institutions. By increasing the reverse repo rate also, Reserve Bank of India will reduce the circulation of money in the economy. In vice versa, if the reverse repo rate is decreased, if RBI reduce the reverse repo rate, what happens? Bank will not show much interest to give loans to Reserve Bank of India, because if they give loans, they will get only minimum amount of interest rates as a returns. So what banks will do, instead of giving loans to the Reserve Bank of India, they will show interest to give loans to the common people, companies or other financial institutions, so they can get more interest rates from them. So this is what happens when RBI reduces the reverse repo rate. So to be more simpler, if RBI increases the repo rate or reverse repo rate, then the circulation of money in the economy will be reduced, which is mainly, the tactics is mainly used to control the inflation of the country. And if the RBI reduces the repo rate or reverse repo rate, what happens? The RBI is trying to boost the economy. The RBI is trying to increase the circulation of money in the economy so that it can boost the economy. So this is what all about the repo rate and reverse repo rate. So please do comment about this video, and also if you not yet subscribed to the channel, please do subscribe, and let's see in the next video. Bye.